Welcome to Accounts School. I am Ms. Meena, your accounting teacher. Today we begin with the most fundamental question: what exactly is accounting? Accounting is the systematic process of recording, classifying, summarizing, and communicating financial transactions of a business. Think of it as the language that businesses use to tell their story in numbers. Every time a company buys something, sells something, borrows money, or pays wages, that transaction is recorded by accountants. Accounting serves three critical purposes. First, it helps business owners know exactly how much money they have, what they owe, and whether they are making a profit or a loss. Second, it helps banks and investors decide whether to lend money or invest in a company. Third, it helps the government ensure businesses pay the correct taxes. The history of accounting goes back thousands of years. Ancient civilizations in Mesopotamia, Egypt, and India all kept records of trade and taxes. The modern system we use today was formalized by an Italian mathematician named Luca Pacioli in 1494. He documented the double-entry system, which we will study soon. There are two main branches of accounting: financial accounting records and reports historical financial information in a structured format for external users like banks and investors. Management accounting provides internal reports to help managers make day-to-day decisions. Remember, a good accountant is like a doctor for a business. They diagnose financial health, identify problems early, and prescribe solutions. Without accounting, no business can survive. Today we learn about the three types of accounts. This is one of the most important classifications in accounting. Every account you will ever encounter belongs to one of three categories. The first type is personal accounts. These are accounts related to persons, both natural persons like individuals, and artificial persons like companies and banks. Examples include Ramesh's account, State Bank of India account, creditor's account, and debtor's account. The golden rule for personal accounts is: debit the receiver, credit the giver. The second type is real accounts. These are accounts related to tangible and intangible assets, things the business owns. Tangible real accounts include cash account, land account, building account, machinery account, and stock account. Intangible real accounts include goodwill account, patent account, and trademark account. The golden rule for real accounts is: debit what comes in, credit what goes out. The third type is nominal accounts. These are accounts related to expenses, losses, incomes, and gains. Examples include rent account, salary account, interest received account, and commission earned account. The golden rule for nominal accounts is: debit all expenses and losses, credit all incomes and gains. These three golden rules are the bedrock of accounting. Every transaction in the world can be classified using these rules. Memorize them. They will serve you your entire accounting career. Today we study the accounting equation, arguably the single most important concept in all of accounting. The equation is simple but profound: assets equals liabilities plus owner's equity. Let me explain each term. Assets are resources owned by the business, things that have economic value. Examples include cash, buildings, machinery, inventory, and money owed to the business by customers, which we call accounts receivable or debtors. Liabilities are obligations, amounts the business owes to outsiders. Examples include bank loans, money owed to suppliers called accounts payable or creditors, and outstanding expenses. Owner's equity, also called capital or net worth, is what belongs to the owner of the business. It is the residual claim after all liabilities are subtracted from assets. The equation always balances, it must balance. This is the most fundamental rule of accounting. Let us see why. Suppose a business starts with the owner investing 1 lakh rupees in cash. Assets increase by 1 lakh, cash. Equity increases by 1 lakh, capital. The equation balances at 1 lakh equals 0 plus 1 lakh. Now the business takes a bank loan of 50,000. Assets increase by 50,000, cash. Liabilities increase by 50,000, bank loan. The equation now shows 1,50,000 equals 50,000 plus 1 lakh. It still balances. Every single financial transaction, no matter how complex, maintains this balance. This is why accountants call it the fundamental accounting equation. It is also the basis of the balance sheet, which we will study in a later lesson. Today we learn about the double entry system of accounting, a concept so elegant and powerful that it has been used for over 500 years without change. The double entry system is based on a simple but revolutionary idea. Every financial transaction has two equal and opposite effects on the accounts of a business. For every debit, there must be an equal credit. This is the foundation of modern accounting. The system was formally documented by Luca Pacioli, an Italian monk and mathematician, in 1494. He described it as the method used by Venetian merchants. Let us understand with examples. Example 1. The business pays cash of 10,000 rupees to buy office furniture. Effect 1. Furniture account increases. This is an asset coming in, so we debit furniture account. Effect 2. Cash account decreases. Cash is going out, so we credit cash account. Both effects are equal at 10,000 rupees. Example 2. The business receives cash of 50,000 from a customer as payment for goods sold. Effect 1. Cash account increases. Cash comes in, so we debit cash account. Effect 2. Sales account increases. Sales is an income, so we credit sales account. Again, both effects are equal at 50,000 rupees. The great advantage of the double entry system is that it catches errors. If at any point the total of all debits does not equal the total of all credits, we know there is a mistake somewhere. This self-checking mechanism makes it extraordinarily reliable. The trial balance, which we will study later, uses this principle to verify accuracy. Today we master debits and credits, one of the most misunderstood concepts for accounting beginners. Let me clear the confusion immediately. Debit simply means the left side of an account. Credit simply means the right side of an account. They are not good or bad. They do not mean increase or decrease in all situations. Whether a debit increases or decreases an account depends on what type of account it is. Here are the rules. For asset accounts, debit increases the account, and credit decreases it. When cash comes in, we debit cash account because assets increase with debits. For liability accounts, credit increases the account, and debit decreases it. When we take a loan, we credit the loan account because liabilities increase with credits. For owner's equity accounts, credit increases the account, and debit decreases it. When the owner invests capital, we credit capital account. For revenue or income accounts, credit increases them. When we earn sales revenue, we credit sales account. For expense accounts, debit increases them. When we pay rent, we debit rent expense account. A helpful memory tool is the word DED click. DED stands for debits increase expenses, assets, and drawings. CLICK stands for credits increase liabilities, income, and capital. Once you master these rules, you can record any transaction in the world correctly. Every journal entry, every ledger, all flows from understanding debits and credits. Today we learn about the journal and the ledger, the two primary books of accounting. The journal is the book of original entry, also called the book of prime entry. Every financial transaction is first recorded in the journal in chronological order, meaning in the order it happens. Each journal entry shows the date of the transaction, the accounts to be debited, the accounts to be credited, and the narration, a brief explanation of the transaction. The format of a journal entry is standard across the world. The debit account is written first on the left, and the credit account is written below it, slightly indented, on the right. This is followed by a brief narration in brackets. The ledger is the book of secondary entry, also called the principal book of accounting. All journal entries are transferred to the ledger in a process called posting. In the ledger, each account gets its own page, called a T account because it looks like the letter T. The left side of the T is the debit side, and the right side is the credit side. The ledger gives us a complete summary of all transactions related to a particular account. For example, the cash ledger shows every cash inflow and outflow in one place. The process flows like this: transaction happens, then it is recorded in the journal, then it is posted to the ledger, and finally the balances are used to prepare the trial balance and financial statements. Maintaining accurate journals and ledgers is the core skill of any bookkeeper or accountant. Today we study the T account, the fundamental building block of the ledger. It is called a T account because its structure looks like the letter T. The horizontal line at the top shows the name of the account. The vertical line in the middle divides the account into two sides. The left side is always the debit side, abbreviated Dr. The right side is always the credit side, abbreviated crossing. Let us see a complete example using a cash account for a new business. Transaction 1. Owner invests 50,000 rupees. Cash comes in, so we debit cash account by 50,000. Transaction 2. Business pays rent of 5,000 rupees in cash. Cash goes out, so we credit cash account by 5,000. Transaction 3. Business buys stationery for 2,000 rupees in cash. Cash goes out, credit cash account by 2,000. Now we balance the T account. Total of debit side equals 50,000. Total of credit side equals 7,000. The balance is 50,000 minus 7,000, which equals 43,000. This is the debit balance, meaning cash left in the business is 43,000 rupees. This balancing process is called balancing the ledger account. When total debits exceed total credits, the account has a debit balance. When total credits exceed total debits, the account has a credit balance. Asset and expense accounts normally have debit balances. Liability, capital, and income accounts normally have credit balances. Today we learn about the trial balance, a crucial checkpoint in the accounting process. A trial balance is a statement prepared at the end of a period that lists all the ledger account balances in two columns, debit balances in one column and credit balances in another. The fundamental rule is that the total of all debit balances must equal the total of all credit balances. If they do not match, there is an arithmetic error somewhere in the journals or ledger. The trial balance is prepared after all transactions have been journalized and posted to the ledger. It serves as a proof that the double entry system has been correctly applied. However, a trial balance that balances does not guarantee that all transactions have been recorded correctly. There are certain errors that will not be detected by the trial balance. These are called errors of omission, where a transaction is completely missed. Errors of commission, where an entry is made in the wrong account but the type of account is correct. Compensating errors, where two errors cancel each other out, and errors of principle, where a fundamental accounting principle is violated. Despite these limitations, the trial balance is an extremely important tool. It provides the balances needed to prepare the profit and loss account and the balance sheet. In practice, accountants prepare a trial balance at the end of every month to catch errors early. Think of it as a spell check for your accounts. It catches most mistakes, but not all. Today we study the profit and loss account, also called the income statement. This is one of the two main financial statements that every business prepares at the end of each accounting period, typically annually. The profit and loss account shows all the revenues earned and all the expenses incurred during a specific period. The difference gives us either a profit or a loss. The profit and loss account is divided into two sections. The first is the trading account, which calculates gross profit. Gross profit equals net sales minus cost of goods sold. Net sales is the total revenue from selling goods, and cost of goods sold includes the cost of buying or manufacturing those goods. The second section is the profit and loss account proper, which starts with gross profit and then deducts all operating expenses like salaries, rent, electricity, depreciation, and advertising. After adding other income like interest received and commission earned, we arrive at net profit or net loss. Net profit is the final profit after all expenses are deducted. Net profit is good news. It means the business is making more than it spends. Net loss means the business is spending more than it earns, which is unsustainable long term. Net profit increases the owner's equity, while net loss reduces it. The profit and loss account covers a period of time, usually one financial year. In India, the financial year runs from the 1st of April to the 31st of March. Remember, the profit and loss account answers the question, did the business make money this year? Today we study the balance sheet, the king of financial statements. While the profit and loss account shows performance over a period, the balance sheet shows the financial position at a specific point in time, like a photograph of the business on a particular date. The balance sheet has two sides. The left side shows all assets, everything the business owns. Assets are classified into fixed assets and current assets. Fixed assets are long-term assets used in the business, like land, buildings, plant and machinery, and furniture. Current assets are short-term assets that change frequently, like cash, debtors, stock, and prepaid expenses. The right side shows liabilities and owner's equity, how the assets were financed. Liabilities are classified into long-term liabilities, like bank loans and debentures, and current liabilities, like creditors, bank overdraft, and outstanding expenses. Owner's equity includes the capital invested by the owner plus any retained profits, less any drawings made by the owner. The balance sheet must always balance, meaning the total of the left side must equal the total of the right side. This is because assets must equal liabilities plus owner's equity, the accounting equation we studied earlier. The balance sheet is used by banks to decide whether to grant loans, by investors to decide whether to invest, by suppliers to decide credit terms, and by the owner to assess the net worth of their business. It is truly the most important single document in accounting.